Hello and welcome to this video. I am Dr. Subayal and in this value-packed video, we will thoroughly understand the underlying concepts that will help us in answering the question, should we start investing in index funds, for example, S&P 500, when the prices right now are around the all-time highs? So in this video, we will use S&P 500 as an example, which is trading around 4,300 US dollars currently, which is not that much below its all-time high of around 4,500 US dollars. So of course it does not matter when you watch this video. So this content will give you value years from now, since the concepts explained in this video are very important to understand. So if you are just starting your investing journey or already investing in the stock market, I am sure that this video will help you in looking at the things from a much wider perspective. So take a pen and paper and take notes. And if you have any questions, please feel free to ask the questions in the comment section below and I will definitely answer them. So many of my followers and friends look at the price chart of S&P 500, and when they see that the price is near the all-time high and its cumulative PE ratio is also very high, they think that it might be the time to wait for a correction so that they can buy it for a cheaper price. So they are not alone in this boat, I have to admit that. In fact, we all want to time the market, and honestly, even I would like to pay less for the value that I am getting. But we cannot predict the market, that is the problem. So in this video, we will focus on S&P 500. Since it is an index fund, and index funds are excellent investment instruments because they help us in diversifying across various firms in different sectors and countries. Just in case if you are new to investing, I will provide a link to the video at the end of this video, which will help you in understanding the difference between different types of funds. But in short, index funds help us in lowering our risk because they give us the ability to bet on various sectors and the economies of nations or regions so that we don't end up betting on one company or put all our eggs in the same basket. So to answer our question, we will first look at number one, the opinion of two of the world's most renowned investors regarding timing the market. And then afterwards, we will look at the cost of timing the market and the cost of long-term investing. Once we have covered these parts, we will look at an actual concrete example which will be an eye-opener and it might surprise you. So we will go back in time and find a scenario where the price of S&P 500 had risen considerably and reached an all-time high at that point in time. And we will calculate the actual returns if we had started investing around 20 years back. And after going through all these four sections in the video, we will come to the fifth section, in which I will list the 5 key conclusions, and I will tell you that you must keep in mind these 5 points since they will help you in your investing journey. So please watch this video till the end because it will give you a concrete idea of what is achievable by simply dollar cost averaging and betting on the economies of nations and different sectors instead of individual stocks. So let's first have a look at the opinion of two of the world's greatest investors. So in this interview, Warren Buffett emphasizes the importance of long-term investing.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to. And it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776. And that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be.
And the key takeaway of this video is summed up in one of his quotes. The stock market is designed to transfer money from the active to the patient. And according to Charlie Munger, who has been working together with Warren Buffett for decades, It is in the nature of stock markets to go way down from time to time. There is no system to avoid bad markets. You can't do it unless you try to time the market, which is seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go. And now let's have a look at the cost of timing the market. Now, timing the market is where a person tries to predict the future. Although it sounds ideal to buy stocks at lower prices and sell them shortly after it has made a huge profit, and also on the other hand, short the market when prices are falling off the cliff. But short term trading is complicated, and we can often get caught in the hype and end up making investing decisions that can cost us a lot. And it is not just about money, it is also the emotional cost and the time, which is the most valuable resource. So I have seen people spending a lot of time observing the market with the pursuit of trying to constantly implement the buy low, sell high approach. In other words, they are on a constant pursuit of determining the lowest prices so that they can enter the market at those precise points and later on sell the stock at a higher price and make short-term gains. And surely, many a times they are also motivated to short the market at or near the precise times when the stock has risen in price considerably, which has the same emotional cost and the cost in terms of most valuable resource also, which is time. And now let's have a look at the cost of long-term investing. Just like short-term investing, there is also a cost of long-term investing. So long-term investors usually use dollar cost averaging and don't try to time the market. In other words, they don't try to enter the market at around the very low prices when the prices start surging upwards. And they also don't try to short the market at around the higher prices when the market just starts correcting. Therefore, they are unable to leverage on the short-term volatility. Now, surely that is mostly intentional, but anyways, this is the price which they have to pay. Now, of course, value investing is all about paying a lower price for the value that we get. And definitely they look at the PE ratio and other important numbers and ratios to buy the stock at a cheaper price. But the point which I want to make is that they don't waste their time and emotional energy in timing the market, and they look at things from a long-term perspective. So of course, people like me miss out some of the best performing days of the stocks or index funds, but we must understand that allocating a lot of capital at once and avoiding dollar cost averaging increases our risk considerably. And now let's have a look at the fourth important point, which is importance of time in the market. Now, instead of trying to time the market, I believe that spending time in the market is more likely to deliver good returns over long term. It also removes the anxiety of losing part or all of our life savings or the money which we have allocated for investing. It also mitigates the wastage of our most precious resource, that is time, and it also helps us in detaching ourselves from the constant battle of controlling our emotions during the short-term trading. Of course, it means that we will encounter rainy days along with the sunny days, but it has been proven by the history that the markets and economies always grow over time and are resilient to short-term economic events, as Warren Buffett said in this interview.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. And I pointed out that if you put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
And as we can see in this picture, there have been many economic events since 1980 which influenced the price of S&P 500, and one major drop in price was in 2008, as we can see, and it was due to Lehman Brothers collapse. But eventually market recovered after that. And it is also obvious over here that the market recovered after all the other short-term economic events shown in this picture. So the economies of nations are resilient to short-term economic events, and that is due to this reason that S&P 500 has been giving an average annual return of over 10% over many of the past decades. So let's answer our main question with a concrete example now. So our question was, should I invest in the S&P 500 at the current prices where the PE ratio is also very high? To answer this question, let us go back in time. So the price of S&P 500 went up tremendously from October 1994 when it was 412.52 US dollars to August 2000 when its price reached an all-time high at that point, and it was 1493.29 US dollars. So after that, a brutal correction occurred and the price dropped from 1493.29 US dollars to 809 US dollars in just 2 years, and it was a huge drop of 45% during a time frame of just 2 years. So I don't have a slightest of doubt that many short-sighted people panicked and sold their holdings due to the fear created by media and deprived themselves of the enormous gains that they could have made during the coming 2 decades, even if they have entered the market at all-time high at 1493.29 US dollars. And even worse, they would have made the paper losses real. Now we know one side of the coin, which is how much money they could have lost during this correction. So let's now look at the other side of the picture, meaning how much money they could have made till now if they had started to invest in S&P 500 in September 1990 and not pulled their money out despite many of the corrections that occurred along the way. So let's calculate how much actual gains we would have made till now without caring about all the market corrections and all the bull markets along the way. So if I have started my investing journey with 10,000 US dollars as an initial amount in 1990 and regularly invested 300 US dollars each month since then, in that case, irrespective of the price fluctuations, I would have harnessed the power of dollar cost averaging to make enormous gains. So right now in 2021, after like 20 years, the final value of my portfolio would be over 941,000 US dollars, and the total invested amount including all the monthly installments would be 121,300 US dollars. And even after the capital gains taxes, you would still be left with over 834,000 US dollars. So you would have essentially increased your wealth by over 7 times. This is well over a 600% gain, and that also includes the 50% price drop after the 1994 housing crash and all the nasty corrections that occurred along the way in the past 20 years. And of course, even if I factor in the inflation, you would have still increased your wealth by over 4 times. So here is what we conclude from these lessons. Number 1, there is no need to time the market. Number 2, the time in the market is very important for long-term huge gains. Number 3, the cost of long-term investing is that it deprives us from leveraging the short-term volatility to make quick gains, but they are difficult to make anyways, and it can be stressful to find the right entry points. And it also has an emotional cost attached to it, and also the cost of time. And the cost of timing the market is being out of the market when it surges upward, contrary to what we expect. So for example, sometimes it so happens that the day traders, they try to time the market, but they expect that the price will go down. But contrary to that, the price goes upwards and they lose a little bit of money depending on where their stop loss is. And it is also true in the opposite direction when they try to short the market. And the fifth and most important conclusion is that the economies of nations are resilient to short-term events and they always recover, as we saw. Thank you very much for watching the video. I hope that this video has given you a lot of value. If you will like to watch such content about long-term value investing and personal finance, please subscribe to this channel, hit the notification bell and select the option all so that you can get the notifications of the videos as soon as they are released. And I will see you in the next video. Bye.